The fourth quarter results for HSBC were characterized by weak revenues, as you said. It was a miss of around 1 billion, mostly driven by weak revenues in capital markets, but also in the insurance business. On the operating cost side, costs were broadly in line with expectation. Now, for the full year, the return on tangible equity, which is the measure which is targeted by the bank, was in the region of 9%. It was 8.6%, so still an improvement when compared to the previous year, 160 basis points, but well below the 11% return on tangible equity.
They talk about a challenging environment going forward, and yet they're maintaining their forecast for 2020. Based on the numbers you've seen here, do you think that's realistic?
It is indeed a challenging economic environment and also a market environment. On one side, you see volatility in capital markets, and that constrains the ability of banks to deliver on the capital market business. On the other side, there is some slowdown in the macroeconomic scenario, and therefore we see pressure in the net interest income, but also in the revenues.
Now, interesting comments there from Stevenson around the UK posing a bigger risk than China. And we just saw that they booked 165 million in credit losses relating to UK macro uncertainty, really. So how concerned should we be specifically about the impact of what's going on in the UK, specifically about Brexit?
HSBC is actually the second bank who provisioned against Brexit. The first one was RBS during the third quarter results. Now, these are generic provisions, they are not specific, so there is no deterioration in sight, at least in the short term. But clearly the macroeconomic environment is deteriorating, and management is becoming more cautious.
This concept of better safe than sorry, let's book these now, get ahead of the curve. I wonder though, when you look at the scenarios over the next 5 or 6 weeks, do you think that major banks, including those based in the UK, have done enough already, or is there still work to be done? Are they ahead of other sectors dramatically when it comes to preparing for no deal?
I think there are two orders of impact coming from Brexit. The first one is really the lost passporting, and in this respect, UK banks are well advanced, also because of requirements from the regulator. Most banks have now set up subsidiaries in the EU. On the other side, the second order of impact is coming from the deteriorating macroeconomic environment, and that, the impact will depend very much on whether we're going to have soft Brexit or hard Brexit.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.